All right, let's dig into a real head-scratcher today with Trupanion's latest earnings. On paper, it looks like they absolutely knocked it out of the park. But the market? Well, the market told a completely different story.
And yeah, this is the big disconnect we've got to unpack. You've got the company delivering this fantastic, record-setting quarter. Profits are up, growth is accelerating, and yet, the very next day, the stock gets hammered, dropping over 8%. So what in the world did Wall Street see that the headlines missed? Let's break it down.
So first things first, let's just look at the numbers because they really are impressive. You can see why management sounded so confident on their earnings call. Okay, get this. The earnings beat was huge. Wall Street was expecting maybe, 8 cents a share. Trupanion comes in and delivers 13. That's a 63% surprise to the upside. It's a really clear sign that their profits are growing way, way faster than their costs.
And it wasn't just on the bottom line. The top line looked great too. Revenue came in at almost $367 million, which was a solid $5 million more than analysts were looking for. So this isn't just about cutting costs, right? It's about real growth in their main business.
Now, for a growth company like Trupanion, this is the number I was watching. New customers. And boy, did they deliver. They've totally reignited their growth engine, adding 16,000 net new pets. That's a 45% jump from last year, and it's their best quarter for growth in almost 2 years. That's big.
And the good news just keeps rolling. I mean, look at this, a record subscription margin at 15.5%. Adjusted operating income is up a massive 27%. They're churning out record free cash flow. And this is so crucial for a subscription business, their customer retention actually got better. These are all the signs of a really healthy, well-run operation.
So with all these wins in their back pocket, management basically sent a crystal clear message. The last 2 years of playing defense, that's over. It is officially time to go on offense.
And this quote from the CEO, Margi Tooth, really says it all, doesn't it? She's basically saying, look, we spent 2 years strengthening the business, and now we are ready to get aggressive and really go after this pet insurance market, which, by the way, is still wide open for growth. And listen, this isn't just talk. They're putting serious money behind this new offensive push. They've got a new, cheaper line of credit that's going to save them millions in interest. They've locked in a new distribution deal with BMO up in Canada, and they're taking all that record-free cash flow and plowing it right back into getting more customers. I mean, that's the classic playbook for firing up growth. So the case for the bulls is pretty clear, right? Record results, accelerating growth, and a super confident strategy. Which brings us right back to our mystery. Why on earth did the market punish a stock that had so much good news?
Well, it seems like this whole disconnect really boils down to two big worries that just kind of overshadowed all the good stuff. First, you got to have some context. If you zoom out and look at the past year, while the S&P 500 and the insurance sector have been chugging along with gains, Trupanion has been a huge laggard, down 33%. That kind of history makes investors, well, it makes them nervous, and they're quick to sell even when the news is good. The second thing, and this is probably the biggest issue, is the valuation. Trupanion is trading at a price-to-earnings ratio of over 100. Just to put that in perspective, your average insurance company trades at around 13 times earnings. This means Trupanion is priced for absolute, flawless perfection. There is zero room for error. So investors are worried that the company just can't possibly grow fast enough to justify that kind of premium price tag.
Okay, so how do we balance all this? The great results on one hand and the huge valuation on the other. What's our take on Trupanion from here?
Here's our thesis for the next quarter. First off, management's own forecast is for more of the same, steady, solid execution, so no red flags there. Second, we think the stock is going to continue to be a battleground. You'll have the bulls pointing to the strong fundamentals and the bears pointing to that sky-high valuation. So that brings us to our final rating, market perform. The company's doing a great job, but honestly, its stock price already reflects that success, and maybe then some. At this price, the risk and the reward just feel pretty evenly balanced.
And as always, remember, this analysis is for informational purposes only. This is not financial advice.